Here's one for you now, especially if you're a fan of acronyms. Today, Safcom, South Africa's clearinghouse, appointed by the JSE Securities Exchange to provide services to the local exchange-traded derivatives market, became the first in the world to qualify for CPSS-IOSCO compliance. In our studio at the JSE now is somebody who's going to explain exactly what that means, and that's Leila Fourie, who's a Director of Post-Trade Services at the JSE. Leila, I'm not a great fan of acronyms, but I can see that this is important given the burgeoning derivatives market locally. What does it mean?
Effectively, the very long acronym CPSS-IOSCO stands for a series of really integrated risk management principles that were created by a global body. So much in the way that Basel 1, 2 and 3 was created for banks. The BIS and a number of other acronym-filled bodies created a series of global standards, and they did this to try and standardize risk management practices globally, and especially for exchange-traded and potentially OTC-traded instruments. And the idea behind it is really to create standardized and improved and enhanced investor protection and improved risk management standards that would give an investor confidence to trade across different markets across the world.
Now, Leila, you've become the first to actually qualify for this recognition. What kind of boxes did you need to tick to be awarded this?
It's obviously an enormously complex exercise, and we are very grateful to our regulator for the comprehensive way in which they went about evaluating us. What effectively is required is that a clearinghouse, in our instance, complies with a number of very detailed principles. There are 24 principles, and these principles range from making sure that clients' funds are segregated and separate, that we don't mingle them so as to avoid the losses that we experienced in some of the prior defaults during the height of the crisis in 2008. It also requires that very stable statistical models are in place to manage margin and to manage default fund contributions. And then there are a lot of very basic and logical requirements that are centered on things like governance, adequate governance, transparent management of processes around risk management, and effectively just ensuring that good risk management practices are in place. And these principles are all really designed to ensure that markets are managed in a very transparent and investor-protected way.
Leila, you say there's currently 320 billion rands worth traded on the derivatives market in South Africa at any one time, and you go on to say 14 billion rand in initial margins to guarantee settlements. You mentioned something very, very important, one very important word in a previous answer. You said confidence. I would imagine that in order to achieve those sort of volumes and to continue growing those sort of volumes, particularly the overseas investor needs to be confident, and that's what you've achieved.
Absolutely, and what we've seen globally is that segregation of funds is coming under increasing scrutiny. And in many instances, prior defaults didn't necessarily, in certain global instances, segregate funds. And effectively that means that if you're investing in a market, you don't want for your margin to be affected by another client defaulting. So you want to put margin up and ensure that that margin is safeguarded against any other defaults that occur in the market. Now, South Africa has always segregated its assets down to client level. Effectively, that reduces leverage because it means that you have to have margin and capital to safeguard each separate position. But when a default does in fact occur, it means that your funds are safeguarded and you ensure that the trade that you placed in fact settles and you get settlement assurance. So this is a vital point, and it's a point that's receiving increased scrutiny in developed and developing markets alike.
Of course, Leila, you are the first in the world to qualify for this, as I said, and being first in the world, you're obviously ahead of the curve. How are your counterparts performing in this context? Because the pressure must certainly be on, specifically with Basel III coming into effect in January.
Yes, indeed. The pressure is certainly on, and we've been under enormous scrutiny by our local banks. The Basel III capital impacts are profound in terms of the amount of capital that we would have to be holding for banks that clear through central counterparties that are not compliant. Which really meant that our compliance was vital. We think that global CCPs and clearinghouses are all working extremely hard to ensure that they are compliant by the 1st of January. And we anticipate that many clearinghouses will be coming out with announcements that they have complied based on their regulatory approval.